And then lastly, we have John. John is a chiropractor out of Texas. He borrowed $200,000 to go to chiropractic school. I don't know if you knew this, but chiropractors, naturopathic physicians, acupuncturists, veterinarians, they all have a tremendous amount of student loans because you have to go to medical school and then specialize. So anyway, John, he had heard of these programs. You know, like I said, I didn't invent income-driven repayment and forgiveness. So he had heard of them, and he took his $2,000 a month payment down to $1,000 a month, but he was still having trouble keeping the lights on at the business because, um, chiropractors, are on a thin margin a lot of the times. And so he had been paying about $1,000 a month for a while, and before we met, and then I set him up in the 25-year forgiveness plan because his loans are super old. And I was like, look, John, you're a business owner. And just like with taxes, we can use that to our advantage. Basically, we can take the expenses from the business and use them to offset your income. For in layman's terms, what that means is, even though on paper, according to his taxes, he was making good money, he was paying himself in actual dollars very little. And so we're able to show that to the Department of Education, what was actually putting in his pocket. We're able to lower his payment to rock bottom, down to zero. And, as long as he's a small business owner, and it depends, of course, on how much he's going to pay himself, but we could probably keep his payment extremely low for the next 25 years and save him almost the entire $200,000. Okay. So I just got like one or two more slides, and then we'll jump into Q&A, which is I'm pretty good on time, actually. It's gonna be about another 5-7 minutes and we'll be there. So if you haven't started to have the wheels turn here, let me just kind of put a punctuation mark on this, which is this: with Evolve Financial Partners and with financial advisors like them, what we're able to do is free up money in someone's budget and have that money go to growing assets in the future. Basically, I like to say, I think it's the next one. Yeah, we turn liabilities into assets. It's a win-win-win relationship, right? We save money for you, the borrower. You're able then to invest it. Everybody's happy. We want to make sure that the money we save does not go up in smoke. Every single one of those examples that I gave you, they came to us at College Loan Freedom through a financial advisor and took the savings, or at least 50% on each of those clients, and invested that savings for them and their family's future. That's how you really beat the student loan game. All right. You take money that would have gone into a vacuum of debt and you use it to grow wealth, so that at the end of the period of the 20 or 25-year, 10-year cycle, whatever it is, you not only have the student loans off your back, but now you have a huge nest egg to show for it. So definitely make sure you get back with the person who invited you to this webinar and sit down with them if you want to see if, all of us can make that win-win relationship possible. All right. So let's get through some FAQs and then we'll jump into the Q&A. All right. So real quick, we charge our fee to work with College Loan Freedom is, first of all, our consultations are always free. Right? So getting on the phone with your financial advisor and us is a free consultation, just like you would with a tax professional, right? But if you want us to implement a plan for you, we charge 30% of the savings over the first year. So let me just show you how that breaks down real quick. So if we're able to save $500 a month, that's $6,000 over the first year. What could you do with an extra $6,000, right? So we would charge 30% of that, which is $1,800. And then we'll typically break down our fee into low monthly payments, spread it over 6 or 10 months. So that way you still see real world savings that you can invest right away, right? So if we're saving 500 minus our 180, you have $320 a month so that you can start growing assets for yourself or growing bigger ones. All right. That's how our fees work. Is there a minimum amount of debt we work with? I get this question a lot. I just got it 2 times today already. We don't take on clients with under $20,000 worth of student loan debt unless they are in default and need help getting out, or they want help managing the crazy minefield that is public service loan forgiveness, we will help with that. But typically when people have 20,000 or under, you got to remember they're only paying 150, 200 bucks a month. So with our fees, with managing, with forgiveness, they're not going to see it. So we don't see a lot of value. They don't see a lot of value. So we don't take on those clients. Okay. Mortgages. As I said in the beginning, number one reason people are getting turned down before COVID was mortgages, was student loans. So we have a solution for that. I do these kinds of trainings for mortgage brokers all over the country to teach them how to get people with student loan debt, high student loan debt especially, through the underwriting process, through Fannie Mae, Freddie Mac guidelines, FHA and VA guidelines as well. So we have a solution for that if you are having problems or getting turned down. Credit. I never thought in my entire life I'd ever be excited to talk about credit, but finally I am. So look at that. We have found over the last 18 months, blood, sweat, and tears, we found a way to get student loans fully removed from credit reports altogether, permanently. Whether they're federal, private, or Parent Plus, doesn't matter. We can get them off of a credit report so that they don't affect your financial life going forward, okay? And then CARES. I told you I'd talk a little bit about the CARES Act. All right. So if you remember from the beginning, I'm just going to briefly catch up. Back before 2008, student loans were lent by banks and then federally insured, kind of like mortgages are today. And then after 2008, when the mortgage crash happened, lending stopped, but we couldn't stop it for education. So the Department of Education itself stepped in and they became the lender. So all loans after 2010 and pretty much starting in 08 are lent directly by the Department of Education. Roughly 2/3 to 70% of all student loans are lent from the Department of Education, which means our IRS tax dollars are funding student loan debt. That's a whole nother subject for another time. But anyway, when the CARES Act was implemented on 3/27 and now extended by President Trump, everybody with a direct loan, all the loans lent directly from the Department of Education, they don't have to pay, there's no interest, and all the time that they're not paying is counted toward forgiveness. People with the old style loans and private loans were left out of this. So they're still having to pay. So those people we definitely want to work with and talk to. Right now, the CARES extension runs till January 1, December 31 technically. So most people are going to start paying again in January unless it's extended again. Which I could talk all day about, what's going to happen in the election, but I don't think that's prudent. If you want me to, if it's a big question, I will. But bottom line is this, right now, it's going to run till December 31st, and we're going to start paying again. It might get extended. It might not. We'll see. Okay? All right. So that's all I have for you guys, except for Q&A time. I know I saw a couple things in the chat. That's my book right there if you want to look it up on Amazon. That's our website. Our website is collegeloanfreedom.com, obviously, and that's the email. But make sure you get back with the person who invited you to this webinar if you want us to go over your specific situation with you. So I will jump into the chat here and see what we got. Okay, Katie. All right, so this question has to do with PSLF. Okay. So there's a question from Anna King about my slide about Katie with public service loan forgiveness. And I get this one a lot. When it comes to public service loan forgiveness, we got to remember one thing. This money, this forgiveness is basically free money being given by the government. And I don't know if you guys have been dealing with SBA or PPP, but it's a nightmare. So in the same way that money's being given away from the government, of course they're going to make us jump through a ton of hoops in order to get that money, right? So the hoops that have to do with public service loan forgiveness are kind of big barriers. And if you look and do any research, public service loan forgiveness is getting a really bad name right now because only 1.5% are getting forgiven. 98.5% of people are getting turned down because they don't know the hoops. And so Anna's question is about the example where Katie had been paying for 6 years, but that 6 years did not count toward the forgiveness program. So we had to start everything fresh. She had FFEL loans. She had the old style loans. So we had to turn them into the new style. So with public service loan forgiveness, you have to have the major hoops are this. You have to have the right type of loans. direct loans only. You have to be in the right repayment plan, meaning you have to be in an income-driven plan or there will be no money left over, right? So you have to be in an income-driven plan to leave money left over, and you have to be working at least 30 hours a week for a nonprofit or government entity while paying on the loans. So all those 3 hoops have to be jumped through, plus there's 2 minor hoops. You have to be with the right servicer, and you have to do the paperwork every year to make sure your time counts. But if those 3 major hoops are not counted or not done right, then none of the past time counts, which is why we're running into so much problems, which is why my company helps people with that. So hope that answers your question, Anna. Okay. Is Great Lakes a Department of Education loan or private? Great Lakes is specifically, this is from Jewel, I'm going to butcher your last name, I'm not even going to try. So Great Lakes is specifically a federal lender only, or a federal servicer, excuse me. The lender is the Department of Education. The servicer, there's only a handful that are only federal, but that's one of them. So Great Lakes, Nelnet, Fed Loan Servicing, Ed Financial, Mohila, those are all only federal servicers. The rest either do both or are just private. So, okay, let's see. Let's go down, keep going. I'm a registered as PSLF, having a payment system for a while. Is it appropriate to change service switch from them to you? Okay, so real quick, I want to make this abundantly clear. College Loan Freedom is not a servicer. College Loan Freedom is similar to a tax professional, right? So we're the experts you come to have us deal with your servicer. So the question was, should I switch servicers to you guys? We're not a servicer, but similar to a tax professional where you're going to go sit down with H&R Block and you're going to pay them a fee to help you not overpay the IRS. So you might have to pay them and the IRS, but they're like, advisors in your corner. We're the same thing when it comes to student loans. So we are there for you to help make sure you don't overpay and make sure you take full advantage of the programs available to you. So we are not a servicer. The loans do not come to us. They stay with the federal government, okay? When can we start enrolling college graduates into this program? Can we read them all? Okay, good question. So this is from Ray. We cannot put people into the programs, or nobody can put themselves into these programs until you leave school. So if you're in school, everything is frozen in place. And then when you leave school, literally the day after graduation, Ray, we can get people into these programs. So, but if they're going through, if they're in school, or even if they go back to school, but if they're in school at all, pretty much they're frozen in place, and we have to wait for them to finish. Okay. All right, from Teresa, just to be clear, there's a 30% fee of the loan amount. No. There's a 30%. Our 30% fee is based on the savings. So if we can't save any money, we don't charge anything. If you're not paying, then we have a base rate for our fees. But our 30% fee is based on the savings. So hopefully that clears things up, Teresa. Can someone be approached to switch between different forgiveness programs if they switch jobs and maintain the timeline count? Okay, Shantae, this is kind of deep. This is kind of in the weeds, but I'm gonna do my best to get it through real fast. Okay, so the question is, can we switch programs from the income-driven plans or the forgiveness plans? Okay. Yes. First of all, let me make this abundantly clear. You can switch between any of the income-driven plans at any time. So you can switch from IBR to repay, pay as you earn, income contingent. You can switch between them. It's your prerogative, right? We can do that, no problem. So, however, when you're talking about switching between forgiveness plans, does that time count? Typically, no, but it depends. It just depends on your situation. Like, if you're an IBR and we want to switch you to repay, those are both 25-year forgiveness plans, so that time will count. If we have to consolidate the loans, no, everything will start from scratch. If we switch from IBR, which is a 25-year, to pay as you earn, which is a 20-year, the time will not transfer over. So I hope that answers the question, Shantae. It's really specific, and that's why we go through and audit files, and we'll let you know when you and your advisor are talking to us. Okay, all right. So can you be in an income-driven plan if you're unemployed? Absolutely. This is a great question, Angel. Angel. So Angel asked, can you be in an income-driven plan if you're unemployed? Absolutely, you can. I actually recommend that, because if you are unemployed, let's just say you're laid off for a week, or you're in between contracts. This happens a lot. Or you're a teacher over the summer who doesn't get paid. We want to take advantage of that. I just had a client literally yesterday, an attorney with $360,000, who was in these plans, but she is moving from Florida to San Diego, and she's going to have a 2-week break of no income. So we're using that 2-week window to lower her payment to rock bottom, because that payment will last for the next 12 months. So absolutely, you can get into these programs when you're unemployed. And I implore you to do so, because not only will it last longer than any forbearance or anything with the CARES or COVID, but that time will count toward forgiveness. All right. So definitely want to take advantage of that. Or also, just to be clear, you saw the fluctuation when you're on income-driven repayments. If your income drops, we can lower that payment right away. If you get laid off or whatever, or you're having to take a hiatus or less hours because of COVID, definitely want to lower those payments right away. Do you have any consultations on private student loans? Yes. Now, unfortunately, there's not a lot that can be done with private student debt. Private student debt, in my opinion, is probably the worst debt in America to have, for a couple of reasons. One, you can't bankrupt it. You can't bankrupt federal either, but you can't bankrupt private student loans. You can't, there's no usury laws. They can charge whatever interest they want. There's no statute of limitations on the debt. So private student loans, there's basically only two solutions. All of my years doing this, I've only found two. I'm working on a third, but it's a long shot. Long story short, the two are this: you refinance it and pay it, or you settle the debt. Either way, you're going to have to pay something. So we do have consultations for private student loans, but basically it's like a coaching call. Like, let's take a look. Maybe we can fix your credit up to get it help you get refinanced, or we can look at settlement. But I don't recommend it. That's really only for people in a rock and a hard place. Okay, Caprice, you mentioned that there are 6 programs, but you only talked about 4 unless I missed something. So 6 forgiveness plans are this. If you're defrauded by your school, that's called borrower's defense. That's one forgiveness plan. That's 0 time on the clock. Same with if you're permanently disabled, it's called total permanently disability forgiveness. That's the second one. Teacher forgiveness is the third one. So that's for partial forgiveness after 5 years. Public service loan forgiveness is number 4 after 10 years. Pay as you earn is the 20-year forgiveness plan, number 5. And then for everybody else, IBR, ICR, people with older loans, repay, that's the 6th one. It's the 25-year plan. Okay. Hope that helps, Caprice. Michael Rayford, for recent graduation, does there have to be some type of circumstance that makes their loan not affordable? Interesting question. Let me read it again. Sorry, hold on. For recent graduations, does there have to make some type of circumstances that makes them affordable? I think what the question means, if I could summarize, is if we can afford to pay what they're asking us to pay, should we pay it? And that's really up to you. That's really up to you and your advisor. Now, and like I said, over the course of this thing, if the debt is smaller, I would say it like this. If the debt is smaller, definitely under 20, my rule of thumb is to just pay it. If it's average between 20 and 40, we could take a look. Maybe these programs will be beneficial for you in the short term, maybe not the long term. But, money saved now money in your pocket now is always better than in the hands of the government, in my opinion. And definitely if you have loans over 40, 50, 60, 100 plus thousand, we most for sure want to use these programs. So really it just depends on you and, your strategy with your financial advisor. But why not just have a look-see and see, kind of get your options, as it were. I hope that answers your question there. Once you go to these top plans, do borrowers lose their rights that they would have under the federal government, such as for employment? So I want to make something very clear, Teresa. We don't ever change the student loan from federal. the student loan will always be federal. And if you guys take nothing away from this besides what I'm going to tell you right now, let it be this. Never turn a federal student loan into a private student loan for any reason ever. Okay, so a federal student loan has everything I just talked about. It has income-driven repayment, forgiveness, forbearance for 3 years if you need it. It falls into these crazy economic deferment if some other thing like this happens, right? It's in control of the federal government. So you never want, and forgiveness. I mean, I know I've already said that, but good Lord. You never want to turn a federal student loan into a private student loan because you lose all of those benefits. So working with our company, again, we don't change, even if we change the payment plan and do all that kind of stuff or consolidate, it's still federal. It doesn't come to our company. We're not refinancing the loan. And that's another thing I want to make very clear. And again, this is just my opinion from being in the industry this long. You know, when you see companies like SoFi, Credible, LendKey, talk about how much people save from refinancing, what they're not talking about is how much they give up. You know, I talked to a doctor, of course, this was about 2 years ago, who had $600,000 worth of federal loans, was paying $6,000 a month, and refinanced to SoFi because it was a better interest rate. The interest rate is a smokescreen. Anyway, I don't want to get down that rabbit hole. So he turned his federal loans into private loans. Basically, what he did was he ensured that he's going to probably have to pay back $1 million worth of student debt. If he'd have kept them federal, I would have probably lowered that $1,000 or $6,000 a month payment to about $1,000 a month because he was a private practice doctor, and we would have probably saved him, I don't know, $500,000. So we never want to take a federal loan and turn it into a private loan. I hope that answers your question. All right, so I've got how much time? All right, we got a few more questions here, and then I'll wrap it up. Things are really jumping. I will call. Okay, so cool. Thank you. Got it. Awesome. As an example, if you switch from a teacher forgiveness to PSLF, for example, I went from a teacher to an executive director for a nonprofit. Will my qualified payments count from the previous 5-year forgiveness program transfer to? That is a super deep question. I love it, Shantae. Let's talk about it. Okay. Question is, if you were in teacher forgiveness, can we switch to public service loan forgiveness? Absolutely yes, if you didn't already get the money forgiven on the teacher forgiveness. Okay, so let me give you a hypothetical. So let's say, and we'll just go back to use Katie, right? Let's say you have $50,000 worth of student loan debt. You've been teaching for 5 years, and you're thinking, well, I can go ahead and apply for the 5-year teacher forgiveness, get $5,000 knocked off of my 50. That's a drop in the bucket. I say, let's use that 5 years and go to the 10 years and get the full thing that's left over forgiven. That's where the magic is at. Of course, it's dependent on how much student loan debt you have. But Shantae, if you didn't apply for the 10-year forgiveness, then yes, potentially we can get that back 5 years counted and then switch it over to public service and have that 5 years there. But if you applied for it and got the money for it, then no, that 5 years is off the table. You can't double dip and have both going on at the same time. Okay. All right, so I think that's the last question, so this is perfect. Can you remove federal student loans from credit report while you are in one of the forgiveness programs? Absolutely, that's what we're talking about doing, yes. So let me talk about the credit removal process, and then I'll just say my thank yous and get out of here. So when we talk about removing student loans from credit report, this is for credit reporting purposes only. It does not mean you still don't owe the debt. Does not mean we still don't have to do all of this magic with the income-driven repayment and forgiveness and all that stuff, right? So they're two separate things. So one, we set up the loans for forgiveness. We get them in the income-driven repayment so that the payment and the debt is handled. And then the other service is to get it removed from the credit report. Two separate services, two separate things that can absolutely run simultaneously. So, you know, we're counting toward forgiveness, we're getting things done, blah, 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 and we're working on the credit report over here. So yes, to answer your question, we can do both. What do you know about Sallie Mae Personal? Sallie Mae is a private student loan debt. If you have Sallie Mae, it's private student debt, okay? All right. I think that's all I got for the chat questions. Hope that gave you a lot of information. Please be sure please be sure that you get back with the person that invited you to this webinar, so that, let me stop. I was sharing my screen this whole time. Sorry about that. All right. So please be sure you get back with the person that got you here. There's Anthony. I'll let you close us out if you had some thoughts that you wanted to wrap up with there, bud. I'm done. Put a fork in me.
Thank you, Larry. That was incredible, and it's pretty clear you're very passionate about what you do here, and you know your stuff. And this is exactly what the partnership that we wanted, to find an organization that can really do it and do it the right way. And I think it sounds like it's in your best interest, if you are in the frame of what he mentioned, to just get a consultation and see if we can help. You never know. And another thing, everybody, you learned a lot tonight. It's really important that if you have other people that are in a situation where this can benefit them, please let them know about this organization. And because there's so many people suffering right now. I mean, after hearing this now, this would be my about third or fourth time now that I've got a chance to listen to Larry. And every time I learn more, and I see why so many people are struggling, why they have so much debt. I mean, that daily interest compound, right? That was one of the things, being a finance guy, daily interest compound, and how interest is front loaded, very similar to a mortgage, where you're paying so much of that interest. And it makes a lot of sense now over the years as I've consulted and seen how much debt people have in student loans, and really not being able to give them a great strategy other than, hey, if they can afford it, pay it down. So